There was a time, not that long ago, when the idea of owning a home, sending your kids to college, or retiring comfortably felt almost unreachable for most people. Jobs were manual, wages barely moved, and wealth? That was something reserved for the elite. The economy moved slow, and for the average worker, it stayed that way. But then, something changed. In the early 1980s, a bold and controversial economic gamble was placed. One that flipped long-held ideas about government, money, and markets on their heads. At the time, it looked reckless. Some called it dangerous. But that single bet sparked a chain reaction, igniting decades of innovation, consumer abundance, and soaring markets. It didn't just reshape Wall Street, it transformed everyday life. And it all started with a simple idea. What if we let money do the work? This is the story of the wild bet that built modern wealth and made everyone richer. Or did it? In 1981, interest rates in the United States were over 15%. Inflation was out of control. The economy had stalled. People couldn't afford homes, businesses couldn't borrow, and the markets were frozen. America was in what felt like a full-blown crisis. Then came a dramatic shift, led by a man with a plan, Paul Volcker, chairman of the Federal Reserve. Volcker did something almost no one had the guts to do. He slammed the brakes on inflation by raising interest rates to punishing levels, knowing full well it would cause short-term pain. And it did. Businesses collapsed, unemployment spiked, and the economy tanked. But by the mid-1980s, inflation had finally cracked, and with it, the doors to a new era swung wide open. Here's where the wild bet begins. As inflation cooled, interest rates began falling. That triggered a flood of cheap borrowing. Suddenly, Americans could get mortgages they could actually afford. Credit expanded, stock markets rallied, and most importantly, for the first time in history, average people started owning assets. In the past, the wealthy owned the land, the stocks, the companies. But now, the average worker had a 401k. Families were buying homes with 30-year fixed rates. Even the middle class was investing in mutual funds. A kind of democratized capitalism was taking shape. This was no accident. The U.S. government had quietly begun shifting responsibility from public institutions to private individuals. Social Security? Still there. But now you were also expected to save for retirement. Pensions were phased out in favor of 401ks. Public housing lost ground to subsidized home ownership. Government took a step back and handed you the keys. This shift was more than economic policy. It was a story about belief. A belief that markets, when left to run free, would lift everyone up. That if you owned a piece of the system, you'd care more, save more, and live better. It sounded empowering, but it came with risk. Ronald Reagan embodied this ideology. He championed lower taxes, deregulation, and free market policies. Wall Street exploded with optimism. The idea was simple. Let wealth creation happen at the top, and it would trickle down to everyone else. In practice, that meant loosening restrictions on banks and corporations. The savings and loan industry was deregulated, allowing more speculative activity. Investment banks gained new freedom to create exotic financial products, and a new financial elite began to emerge. High-flying traders, leveraged buyout kings, and venture capitalists. The 1980s were chaotic and thrilling. The stock market soared, but behind the scenes, the system was already straining. The 1987 crash was a warning sign. So was the S&L crisis that followed deregulation. Billions were lost. But instead of reversing course, the bet doubled down. The government bailed out institutions, kept rates low, and let innovation continue. The message was clear. Risk was tolerable, as long as the reward kept coming. And it did. By the 1990s, the economy was humming again. The internet boom was underway. New companies like Amazon and eBay went public. The Nasdaq exploded. A generation of young investors jumped in, convinced that tech was the new gold rush. Again, this was fueled by the same core idea. Let capital flow freely, and innovation will take care of the rest. Venture capital poured into startups. Stock options became a form of compensation. Retirement portfolios ballooned. Everyone wanted a piece of the market. Meanwhile, the US government played the role of enabler. Capital gains taxes were cut. Financial regulation remained light. And the Federal Reserve, now led by Alan Greenspan, kept interest rates low, keeping the party going. Home ownership surged. College enrollment climbed. Retirement accounts hit record highs. It was the golden age of the ownership society. But underneath it all, something fragile was taking shape. As the 2000s began, the bet had evolved. It was no longer just about letting people invest. It became about encouraging them to borrow, to take on risk, to stretch. If you didn't have cash to buy a home, banks would lend it. Credit standards slipped. New mortgage products offered low payments up front, with risk deferred to the future. Home prices soared, and with them, consumer confidence. Wall Street found new ways to package this debt into complex financial instruments, mortgage-backed securities, CDOs, and more. These were sold globally, spreading risk and exposure across the entire financial system. People felt richer than ever. They borrowed against their homes. They treated the stock market like an ATM. And for a while, it worked. Until it didn't. In 2008, the entire system cracked. Lehman Brothers collapsed. The housing market imploded. Trillions of dollars in wealth vanished almost overnight. Retirement accounts were wiped out. Unemployment spiked. And suddenly, the bet that had once made everyone richer looked like it had gone too far. But once again, instead of scrapping the model, we doubled down. Bailouts were issued. Interest rates were slashed to near zero. Quantitative easing pumped money into markets. And within a few years, wealth creation was back, stronger than ever, but more uneven than ever too. Here's where the story gets more complicated. While the stock market recovered and real estate surged, wages didn't. For most workers, income growth remained flat. The cost of education, healthcare, and housing skyrocketed. And wealth? It concentrated. The top 10% owned nearly 90% of all stocks. The bottom half owned virtually none. The ownership society had delivered growth, but not equally. We'd created an economy where those who owned assets got richer and richer, while those who earned wages just tried to keep up. The bet had paid off, but not for everyone. And yet, the same formula remains in place today. Interest rates stayed low for over a decade. Tech companies soared. A new class of billionaires emerged, thanks to equity, not salaries. And for younger generations, the dream of asset ownership began to slip out of reach. Then came 2020. The pandemic brought the global economy to a halt. But once again, the same bet was used to fix it. The government and central banks poured trillions into the system. Stimulus checks, emergency lending, ultra-low rates. Markets rebounded almost instantly. Crypto exploded. Meme stocks took over. And a new generation of retail investors, many inspired by TikTok, Reddit, or YouTube, jumped into the game. Finance had become accessible, even social. But the problems remained. Inflation surged again. The Fed raised rates, and once more, the cycle turned. It's a familiar pattern by now. Boom, bust, rescue, risk, reward, repeat. And it all traces back to that one wild bet. that private wealth creation, powered by open markets and personal responsibility, would lift everyone together. So, did the bet work? In some ways, absolutely. It unlocked unprecedented wealth, drove decades of innovation, and brought financial tools to everyday people that were once reserved for the elite. The average American got access to mortgages, stock markets, retirement accounts. Entire industries were born from this faith in free markets and individual ownership. But it also came at a cost. It widened the gap between those who owned assets and those who didn't. It shifted financial risk from institutions to individuals, leaving millions vulnerable to shocks they didn't see coming. And over time, the idea that everyone got richer started to feel a bit hollow. Because if your wealth depends on how much you already own, where does that leave the rest? We're now living in the long shadow of that wild bet. It's embedded in everything from how we retire, to how we invest, to how we measure success. And whether you're winning or falling behind often depends not on how hard you work, but on when or if you got in. Still, the idea remains powerful, that with the right tools, anyone can build wealth. The challenge now is making sure those tools truly are available to everyone. So, the next time you hear someone say the market always goes up or just buy and hold, remember, those aren't just investment tips. They're echoes of a massive economic experiment that's still playing out. Thanks for watching. If you found this story thought-provoking, you might enjoy the next one we're working on. Subscribe and stick around. We've got more to explore. Because behind every number is a story, and behind every market chart is a choice.